Good day, everyone, and welcome to this timely webinar on the Greek tax residency legislation. Apologies for the technical glitches, but unfortunately, they're inevitable, notwithstanding our best efforts. My name is John Sotos, and I serve as co-president of the Hellenic Initiative Canada. The Hellenic Initiative's principal purpose is to provide food and medical aid, especially to the young and the elderly in need in Greece. All of our fundraising is done in Canada, and we are a registered charity under the Income Tax Act of Canada. We currently have presence in Calgary, Toronto, Montreal, and Ottawa, and we have plans to expand to British Columbia as well as the Maritimes. Many Canadians have close connections with Greece, where they may own property, have family, or spend time there. In that process, many of us have dreamed about the possibility of living and working part of our time on our favorite beach, town, or village in Greece. And it isn't just Greeks that harbor those thoughts. The chief technology officer of Dell Computers said at a conference just last month, quote, "I can imagine myself living and working from a Greek island. Greece is a beautiful country. It has talented employees and a good technology ecosystem," end of quote. The logistics of accomplishing such objectives, however, are not accomplished without suitable legal and tax underpinnings. The government of Greece recently enacted 3 pieces of enabling legislation to make it a lot easier for Canadians as well as others. I understand we have some US residents and maybe some other country residents attending. So it's made it a lot easier for foreigners, not only to relocate in Greece, but with the appropriate tax planning to save on taxes for some considerable period of time. The laws are designed to appeal to high net worth individuals, employees, small entrepreneurs, and pensioners. So we have a wide audience. The webinar will cover today the benefits and general eligibility requirements under Greek law, the rules of changing Canadian tax residency, and the consequences, as well as pitfalls of changing tax residency from Canada to Greece. We thought there would be significant interest in the subject, but even we were surprised by the overwhelming response we have received. I understand we're close, if not over 350 attendees at this webinar. In order to take you through the basics of these laws, we're thrilled to have a distinguished panel of experts that will address the subject matter, starting with Aspasia Malliou. Aspasia is a tax lawyer with the Athens law firm of Potamitis Vekris, as well as James Belesiotis, who is a tax accountant based in Toronto with an extensive cross-border client base. I will address the legal aspects of expatriating from Canada. At this point, I want to emphasize that the presentation is intended to provide general information only. It is not intended to, and it does not provide legal or tax advice. Anyone contemplating such a move should obviously consult with experts familiar with the laws of both countries. Following the presentation, there will be approximately 15 minutes available for questions, which can be submitted through the Q&A box at the side of your screens. We have already received over 50 questions, and we have tried to incorporate as many of those questions in the presentation as possible. So I would ask everybody to pay close attention in case your question is answered. At this point, we had arranged to introduce to you and in turn introduce the subject of these pieces of legislation of the new Greek ambassador to Ottawa, Her Excellency Kostadina Athanasiadou. But we're having some technical glitches, so we will introduce her when she is able to join us, and I will make a proper introduction at that point. So without further ado, I would like then to call on Aspasia. And before starting, I'd just like to tell you a couple of things. Aspasia is a tax partner at the law firm of Potamitis Beckeris. It specializes in cases regarding taxation of income, capital, and transactions. He is the longtime General Secretary of the Greek Company and Tax Law and Fiscal Studies. He is appointed as Treasurer of the Greek branch of International Fiscal Association, as well as a board member of the Greek-French Chamber Tax Committee. Furthermore, Aspasia is the publisher and director of the biweekly tax law bulletin, Veltio Forολογικής Νομοθεσίας. Aspasia, over to you.
Thank you, John, very much. I'm very pleased to be with you today. As Canada has always been a country that I would like to visit, but up to now, it wasn't possible for me. I had the promise to myself that I will put it in my short list. So after coronavirus, I think that my dream will come true. Meanwhile, I would like to thank you, Natasha, James, and the Hellenic Initiative for the invitation and for all your efforts to make this webinar to become true. Why this webinar? Why this subject? Why now? I think that we all know the very difficult time Greece had during the last decade, in which we lost a great deal of our GDP. Having realized that except from seasides, nice islands, sunshines, and the fact that we are a stable member of the European Union the last decades, we have more to offer to capital, individuals, and private wealth that is abroad and with which we didn't have very strong relations up to now. We are very pleased, we are thrilled that the tax legislator has adopted 3 different regimes in order to attract the private wealth that is outside Greece and to help in that way our growth in the next years. So,
Aspasia, I apologize.
yes.
I noticed that the ambassador has just joined us. This may be an appropriate point to just ask you to pause.
Yes.
And I can ask the ambassador to say a few words. Ambassador, can you hear me?
Yes, I do.
Okay.
Can you hear me?
I can hear you fine. So thank you for joining, and welcome. As I was saying, you are the newly accredited ambassador of Greece to Canada, and you have agreed to provide some introductory remarks to today's webinar, including talking about how these tax residency laws fit into the broader Greek government economic strategy. The ambassador holds a double degree in philosophy from the National Kapodistrian University of Athens and the University of Ioannina. He is a senior Greek diplomat with extensive experience around the world and has held the position of General Director for Economic Affairs at the Greek Foreign Ministry immediately prior to her appointment to Ottawa. Without further ado, I would like to introduce Ambassador Kostadina Athanasiadou with her opening remarks.
Thank you very much. Thank you very much, Mr. Chairman. I will be brief. First of all, I wanted to thank you very much for inviting me today to address your audience, such a distinguished audience. I would like to say a few things on the Hellenic Initiative. As you mentioned, I have been only recently accredited to Canada, but since then, through my general consuls, Mr. Malliou in particular, but directly also, I had the pleasure to keep track of the work done by your organization. And I can sincerely congratulate you not only on the principles you are promoting, Greek-Canadian friendship, the good name of Greeks in their environment, etc., but also on the concrete initiatives and programs you are putting forward. Congratulations, a very good work indeed.
Thank you.
Now, a couple of things pertaining to the economic strategy of my government. As you know, my government was elected on the basis of an ambitious economic program, aiming at the renewal of wealth and the cutting down of unemployment. In this context, from day one, it promoted a bold wave of reforms, amongst which fast-track reforms to renovate the state, laws for specifically remove obstacles for investment or reducing the tax burden for business, etc. Even today, under strenuous COVID circumstances, this program remains fully in track. Greece, over the last couple of years, keeps modernizing structures and is proud to secure a friendly environment for business and investment. A key point to this strategy remains its tax policy. Further to growth-enhancing policies, the government proceeded to tax policies allowing the middle class to be reintroduced to the economic development of the country after years of hardship. However, we have a last point concerning the Greeks abroad. Truly, over the past decade of a huge economic crisis we endured, we have seen an unprecedented brain drain. This certainly needs to be reversed. However, freedom of choice remains a point we all share. My government is thus giving new opportunities for the Greeks of the diaspora to be included in its policies, either the political dialogue by voting or being a part of economic synergy and other things. Well, in this point, I will let the experts talk on the tax residency and the way we should understand this new legislation from the Canadian point of view. I'm looking to the conclusions of this meeting, and I thank you once more very much.
Thank you very much, Ambassador. Much appreciated. And I hope you'll be able to stay throughout this webinar, and perhaps we can reconnect at the end. I'd like to turn back to Aspasia.
Thank you.
Again, thank you for allowing this interruption, and please resume.
Okay, so we can go to our first slide in order to have something to read. Natasha, if it is possible, please. Natasha, are you listening or not? Okay, that's good. We can proceed. We can proceed to the next. Thank you, Natasha. Okay, now let's see what is the general rule for income taxation in Greece. Residents of Greece, tax residents of Greece, are subject to taxation of their worldwide income, plus income derived from Greek sources, except if a double taxation treaty, like the treaty between Canada and Greece, ratified on 2009, provides otherwise, as when a double taxation treaty is ratified in the internal law, supersedes every other internal law according to our Constitution, Article 28. So that's the general rule. Let's see now what the special tax regimes are trying to do. They are trying to provide us with a time-limited motivation in order to attract capital, private wealth, and individuals from abroad, not businesses. Let's proceed to the next slide and see that we have three different options, but with one common result for individuals. If this option is adopted, then we face a transfer of tax residency from abroad to Greece, combined with a preferential tax regime. Let's see how we can do that. Proceeding to the next slide, moving next. We can do that through three paths. The first is through investment in Greece. This program can last for 15 years and it requires 500,000 euros in 3 years after the application. That means that you have to invest in Greece something that will cost 5,100 euros, and you can invest to movable, intangible, or immovable property without exceptions, and you can combine this investment with Golden Visa program. What you have to pay? You have to pay a flat rate of 1,100 euros per annum for all your worldwide income. It is a lump sum. And unfortunately, you are not going to get any credit or deduction for taxes paid abroad. The program runs under the condition that this 100,000 euros per annum is paid in one installment per year. If you gain any income from Greek source, then general internal rule will apply for this income. This program, this path, combines also two interesting things. The first is that you can possibly extend the program to the family members with a small premium of 20,000 euros per year. And most interesting is that you can exempt from inheritance and donation tax for all your sources abroad, for all your capital which is abroad. That's the characteristic of the first path. And now we can move on the second path, the next. The second choice involves pensioners. If you are a pensioner abroad, if you generate pension abroad, you can get and take this program for 15 years, and you are going to enjoy a very low tax rate, 7% per year. And be careful here, because this is the very interesting part. You are going to have this preferential tax rate not only on your pension abroad, but on every income derived for any foreign source. So you are going to get a low tax rate, and moreover, you can have tax credit. Again, if you gain some income from Greek source, you are going to have general internal law on that. And now let's see our third choice. The third choice is a very new one. It was issued during December of 2020. It's through the creation of a new job. This program has to last at least 2 years and no more than 7 years. It concerns employees and freelancers, and the condition means that a new job, a new position is going to be created. So if you would like to make business, to do business in Greece, you can have a permanent establishment or a company in Greece, and you can put a lot of employees, or you can become a freelancer in Greece, having the possibility to enjoy an exception of 50% of income tax and special solidarity tax on this specific source of income. Let's move a little bit more. What are the requirements in order to be able to get the advantages of these programs? For the first program, the individual should not be a Greek tax resident for the past 7 years out of 8 prior to the transfer. For the others, the B and C, it should not be a Greek tax resident for the past 5 years out of 6 prior to the transfer. And we do have a general remark here. Between the state of departure and Greece, an agreement of administrative cooperation should exist in the field of taxation. This is not a problem for Canada, as in the double taxation treaty between Canada and Greece, such an agreement is applied. So, moving on, we have to say that if after listening the webinar, you have decided to get in a plane and come in Greece tomorrow, you are not going to, and you think that you are going to be under these special regimes, you are going to get disappointed, because that does not work like that. How it works? There is a special typical procedure in order to gain this advantage and become a Greek tax resident. First of all, we have to say that we only have the procedure, because we only have ministerial decisions for the procedure only for path A and B. As for path C, the one that for the new job is very, very new, and we don't have yet the procedure, but we think that it's a matter of some days. The first thing that you should be able to acquire is a tax certificate from the country you are going to depart. That means that you are going to that you should have the opportunity, you should have the ability to apply in Canada according the provisions of the double taxation treaty between Canada and Greece, and acquire a tax certificate. Afterwards, you have to apply at Greek tax authorities. You have to apply till the last day of March of each tax year, when you would like to come in Greece. After your application, an administrative decision has to be issued. Tax authority is going to examine your file and is going to decide whether you can apply, whether you are suitable for the, you are okay with the requirements, and then an administrative decision is going to be issued with what the tax authority is going to accept or deny your application. You have to be aware here that tax authority preserves the right to check whether the requirements are met for all the years that the program is going to be alive. Moving on to the next slide, I think that summing up, in order to leave some time for your questions, I would like to make 2 remarks. The first is that we have to clearly separate the tax residency from the residency in general, from citizenship, from nationality, from passport, for maintenance of assets in Greece. Meaning that tax residency is something quite different. It concerns your tax identification, your tax position, and cannot be influenced and cannot influence your nationality, the maintenance of assets, or your passport. Meaning that you can be a Canadian or a Greek national, and you can be a tax resident in Greece or in Canada. Having said that, when and if you decide to depart from Canada and come to Greece, Greece is going to accept, when Greece is going to issue the decision that the country is accepting your tax residency and is providing to you this special regime, Greece is going to consider that you are a Greek tax resident. This might not be the case for Canada, because Canada is going to check what are your relations, the remaining relations with Canada, and if these relations can be characterized as a permanent home or vital interest or habitual abode, then Canada is going to consider that you maintain your tax residence in Canada, and Canada would like to impose tax on you and for your worldwide income. So if you decide to use a program, you should be very, very careful not to maintain bonds in Canada. Moreover, because you are trying to come in Greece and enjoy a preferential taxation, either because you are going to have a very low tax rate, 7%, as I've told you, or you are going to have a deemed obligation to pay tax for your worldwide income. That's for now, and I'm expecting your questions, and thank you for listening to what I have said.
Okay. Thank you, Aspasia, for taking us through a summary of the Greek legislative provisions. And your last remarks were a nice segue to what I'm going to say about Canada. Unlike many countries, Canada does not have an express written definition of what a resident is. And Natasha, can I have the next slide, please? Because there is no statutory definition, the resort is had to the common law, which looks at where the individual maintains his principal residence and ordinary social relations. The practice, the place where an individual routinely, regularly, or customarily lives is really the real test. If somebody has a cottage, if somebody has a winter or summer home in Switzerland or Caribbean, that doesn't count as a tax resident. But the key point is that there is no written definition in our Income Tax Act, so the analysis is fact-driven. Next slide, please. In determining residence for tax purposes, the CRA and the courts consider the following factors. Does the individual retain residential ties with Canada? Does the individual, do they have a house, or do they have a house available to live there? Do the individual's spouse and dependents live with the individual in Canada? Do they maintain social or recreational memberships with organizations that are located in Canada? Is there employment in Canada? Do they carry on an active business in Canada? Their bank accounts there, their pension plans, is the driver's license issued by one of the Canadian provinces? And also, where do they file their tax returns? All of these points are collectively referred to as the Center of Vital Interest tests, and that is how Canada will look at the issue of where somebody is a tax resident. Next slide, please. As Aspasia mentioned, citizenship and residence are two distinct concepts. One could be, because we got a lot of questions on this issue, one could be a citizen of Canada without being a tax resident of Canada, and vice versa. Simply owning property in Greece doesn't make one a tax resident in Greece. And when we're talking about taxes and tax residency, we are not referring to property taxes. Changing Canadian tax residency doesn't affect your Canadian citizenship status. So even if you choose to become a tax resident of Greece or any other country, your Canadian citizenship status is not affected. Next slide. On June 29, 2009, Canada and Greece signed the Canada-Greece Income Tax Convention, which comes into play where there is a conflict between the two countries as to where somebody is a tax resident. There are people who may maintain homes and connections in two jurisdictions. If there is a tax treaty, as there is between Canada and Greece, then the treaty contains a series of cascading rules that allow for the relatively easy resolution of what country one is a tax resident of. Generally speaking, if an individual is primarily resident in another country, then that individual is not a resident of Canada for tax purposes. Next slide, please. If an individual spends 183 days or more in Canada, he or she is deemed to be a resident of Canada. If an individual, however, spends fewer than 183 days in Canada, he or she may be considered to be a tax resident of Canada if the other ties so indicate. In countries where they have fairly strict tests, you don't have to worry about these issues, such as the United States, for example. Abandoning Canadian tax residency is relatively complex and shouldn't be undertaken without expert professional advice. Tax residency can be changed relatively easily, but it should not be driven primarily by tax considerations. Rather, it should be driven by lifestyle objectives. And the last point I want to cover, which sort of answers a question we had from a number of registrants, relates to Article 26 of the Canada-Greece Tax Treaty, which provides for information sharing, broad information sharing, between Greek and Canadian tax authorities. And that is all I have to say on the legal side of expatriating from Canada. And I'd now like to turn it over to James Belesiotis to talk about the nitty-gritty of expatriating and what it means in terms of dollars and cents if you're going to expatriate. James holds a professional tax accreditation internationally and participates in the Canadian Public Accountability Board, which sets audit, accounting, and tax standards for listed companies. James has been an accredited tax specialist in public practice for more than 23 years. In addition to tax, his practice provides audits for listed and unlisted companies, special assurance reporting, accounting consultancy, and practice management services. James.
Welcome, everyone. Thank you for attending. Before we get started, I want to pick off where John left off, which is the tax treaty. And most of you that would be considering leaving Canada would be looking at, asking yourself, what does the treaty mean and why is it relevant? Well, it's relevant. The point of the treaties are really to share data between countries on taxpayers. Really, in 2009, when they had the treaty developed, it was really about pensions between Greece and Canada, and people were complaining about it, and that's where they came into it. From our viewpoint, the treaty, when we analyze it, was really there to prevent two things, right? To prevent fiscal erosion of the tax base in both Greece and in North America, but also to avoid double taxation, but primarily it was for information sharing. Ultimately speaking, Canadian income is still subject to Canadian tax, whether you're resident or not. And it's worldwide income that's really something that will change if you decide to change your residency. So Rule 250, we refer to it, talks about what takes preference when you analyze your personal results. Is it Canadian tax law or is it the treaty? And we have inked in our agreements in our tax act that it's the treaty. So the treaty takes preference. So I only mention this because people that want to get into this sort of agreement will have to understand that you're still paying tax on Canadian income. So when that does happen, you typically will refer to things called departure tax, and we talk about it. We've seen it on the news, and typically super complicated. But I want to summarize it for everyone in 4 key areas that I think will be interesting. The first is the principal residence. Okay, we all have principal homes that we live in, and I'm not talking about the homes that you buy and rent. I'm talking about homes that you live with your wife or your family or husband. These homes typically will not be, well, they're subject to tax-free income when we sell them. And when you leave Canada, you have to dispose of all your assets. That's what we call them, the deeming rules. Consequently, when you break the residency, you lose the status on that principal residence. This is important to know because if you just bought a house and you want to leave, or you recently bought a house, in the future, when you come back, it may be a very different situation than if you've had a home for like 20 years and now you want to come back and sell it. So that's the first thing I want to talk about. The other thing and what are the options for that? There's several. One is you could sell that property to a related party at fair market value, or you could actually file a tax election. The point here to take, though, is the elections are time sensitive, and they're actually must be filed within 90 days of the year in change. So that's what John was referring to, that there's quite a few issues to consider. There's also the situation where you want to get into a business, providing that you have a principal residence and you mortgage that property to put debt on it, you could use that money to invest in Greece, of course, meeting the conditions for residency. The interest, providing there is an expectation of income in Canada, could in fact be deductible. So that could be something that could be considered as well. Okay. The second biggest thing I want to talk about is the unrealized assets. So the deeming rules require that unrealized taxable assets must be deemed disposed in the year that the residency change. Thankfully, there are some changes to the rules. So real property in Canada is exempt from this, okay? But that's not what I'm concerned about. What really concerns me is brokerage accounts. Most of us buy assets and we hold them for long-term basis. We don't gamble our money. And so significant unrealized capital gains will in fact be taxed in the year of change. And in with COVID now, we're seeing our portfolios decrease in value, and that may be a great time to do this because you're reporting at fair market value. The deemed disposition rules would work in your favor. Where I also see a problem is shares of private companies. So shares of private companies where you own directly really have no their market value is very hard to determine, and consequently, it's hard to determine what you report in the year of change. And so we strongly recommend estate freezes. And that's simply also because that in Canada, when you do stuff like that, you're exempt from paying tax on around $850,000 of shares of a small business corporation. And that's why we suggest that. So timing is everything when you do that sort of stuff. Okay, that's the point. The estate freeze, to talk about what Aspasia was talking about, is interesting because it doesn't happen overnight. An estate freeze requires valuations and requires probably a trust, and things like this do take time. So the people that are considering this sort of approach do need to consider that this is something they need to account for. The other thing, although maybe not as important for everyone, is debt covenants and lending agreements. When there is a change of ownership because of an estate freeze, banks usually will see that as a new owner, even though it's really the underlying beneficial owners that own everything. And that could cause lending agreements to be breached. So obviously getting the bank involved and telling them that we're doing this is important. The RSP is another big area that people have in Canada. And fortunately, the advantage is that we could still let the RSP continue to grow in Canada without tax. And that's, of course, important if you have significant funds. I do want to mention withholding tax, though. If you're going to collapse the RSP, timing is everything. If you do it while in Canada, you will be subject to a much lower tax rate than when you remove it if you're out of Canada. And the difference is about 25%. So that's something you want to consider. The other thing you want to consider is that go forward, any passive income in Canada facing you will be subject to a 5 to 10% withholding tax. So if you are in the year of change and now you've reported these deemed disposition rules and now you've reported these gains, you may realize that because of COVID and market conditions, the values have decreased after the fact. Well, believe it or not, there are rules in Canada to carry back some of those losses and recover the tax in the year that you made the change. Usually it's 2 years. The point here, though, that I want to highlight, they are elections that are in the Act. They are time sensitive. And if they're late filed, they're not permittable. So that's the rule that you need to know. People that do find themselves owing tax, if the tax is under $50,000, there's no security required if you're not going to pay the tax. People that are subject to tax over $50,000, maybe because of market conditions on securities, can in fact find themselves posting security. So rather than selling assets, you could just post security of your assets to the Crown. And you could do that, but again, time sensitive, 90 days of a change. And if it's not, you can't go back and do it later. So again, those are those things that you need to know. With regard to small business shares, one of the things that the CRA is concerned about recently too is stripping, dividend stripping, we call it, where you take Canadian corporations, dividend out cash to lower tax jurisdictions. That can in fact be caught under anti-avoidance rules and in fact be subject to advanced tax. We don't see that as a big issue because you'd have to prove intent. Our laws are based on intent in Canada. So we don't see that to be a likely scenario, but it can happen. And to put in perspective to your small business shares that we are talking about, there's a 14.3% change increase to tax permanently after you become non-resident until you become resident again. And that happens because in Canada, the word Canadian controlled corporation means exactly that. Canadian controlled. When you're not Canadian controlled, and therefore there's an increased tax. I've estimated that to be about $71,000 a year. Take that or leave it. That's what it is. The other thing that's important is shareholders that own companies with significant real estate or assets and keep those assets and held those assets for 24 months. Well, you're allowed to have $850,000 of tax-free gains, and that would be subject to an estate freeze or elections that we would do. Well, if you leave Canada and don't do this, you're going to lose your lifetime exemption limit. And that's something that you're not going to get back. So that's something to consider as well. In terms of special filing requirements, I know some of you asked, do I need to still report foreign assets if I'm in Greece? The answer is yes. Canada will still obligate you to report assets that you have outside of Canada worth more than $100,000 on a special election. And in fact, there's an additional disclosure, Form T1161, that's also required at the day that you depart residency. These are very important things that are subject to severe penalties if not complied with. Now, in the US, of course, this is completely different. US residents never leave the US tax system until they give up their green card. So a lot of these rules are even more pervasive to the US resident. But from my viewpoint, these are the Canadian brief considerations of these matters. So I'd like to say thank you for this.
Thank you, James. We're just a minute past our schedule, so we're doing quite well. What I'd like to do now is turn to some questions that we've been asked. We've got lots of additional questions. I'd like to start with a number of related questions that have to do either with the ambassador or with Aspasia. And they relate to, if I can find the questions. Well, what I'm looking for, though, for the questions, I want to say that the webinar recording will be available on our website and YouTube, and the slides will also be sent out. To people. One question that we've been asked relates to, are these opportunities, if you will, time limited, or are they available on an ongoing basis?
Thanks, John. Up to now, they are unlimited. That means that they are here to stay. That's the intention. But they can, the legislator can decide to change it whenever he thinks it will be appropriate to do so. So there isn't any limited, time limited provided by now, but we don't know what will happen in the future.
Right, but the question is, if somebody does these opportunities are not time limited to say the next year or two or three. For now, they're open-ended.
They are all open for now. Yes.
Okay. Thank you.
We have another question here, John. If you're only tied to Canada as an active business, would you still be a non-Canadian resident? The answer to that is simple. It simply depends on other ties to Canada. If you have a business, an active business in Canada, and you're still managing it, you're certainly an active participant in the tax system. Therefore, you will be tied to the country. My gut feeling is yes, absolutely. An active business is exactly that, an active business.
If I may, it depends on the structure of your business. If you are simply a shareholder and you don't have any other kind of connection with the business, then the answer might be that you are not going to be considered as a tax resident in Canada. But if you have, as James has underlined, if you have active relation with the business, then of course there is a great danger that you are going to be considered tax resident in Canada.
Another question I was asked is, if you're only tied to Canada as an active business, like you meet all the other tests, would you qualify as a non-Canadian tax resident? I think the answer is would be yes, but obviously you need to get the proper advice to make sure that your assumption about qualifications are actually correct.
You know, one thing that we want to say about residency is that in our country, in Canada, the word intent is very well detailed in the Tax Act. So, you know, what was your intent when you did something? And if the intent simply was to, you know, leave the country because you want to avoid the tax, well, clearly, you know, you're going to get caught into the trap of paying, you know, severe penalties and stuff, consequences. But you're correct.
Another question that's come in is, we must have some people from the EU listening. What if you're an EU citizen? Are you eligible to take advantage of these pieces of legislation? And the same question was asked by an American resident. I guess, Aspasia, you're probably the best person to answer this one.
Yes, the programs are open to everyone. under the condition that they are not Greek tax residents. That means that you can be a European tax resident, you can be a Canadian tax resident and USA tax resident, and you have to be there for 7 years or for 5 years out of 6, depending on what program you are going to choose. The crucial thing here is where you are a tax resident before you choose the program.
John, we have a question here. Could you maintain a stock portfolio in Canada and disassociate? Of course you can. The whole point of these deeming rules is to keep your assets in Canada while keeping your tax residency separate. Yes, you can. Another
question that might be more relevant to people on the pension side is if somebody becomes a Greek tax resident, what would be the consequences of health coverage in Canada, and what health coverage is available, would be available to somebody who lives permanent or who adopts Greek tax residency? Would there be any health coverage? I don't know if Aspasia, you can answer that, or if the ambassador can.
I cannot answer it very straight, but the general remark that I can have here, I can say here is that in order to have health coverage, a pensioner that is using this program, I think that he has to get inside the wealth system of Greece by paying an annual rate that is something like 8% of his of what he has as an income in order to have health coverage in Greece. So it's not a free thing. He cannot just register to the Greek health system and get coverage, because there isn't any treaty between Canada and Greece that covers this. And I think that the answer here is that he's going to have an 8% burden on his pension in order to get covered.
Thank you. And the answer on the Canadian side depends on what the provincial health authorities stipulate with respect to coverage when you're out of the country. So there's no simple answer. I'll just ask one more question, and then we'll move to closing. And the question, it's a two-part question. The question is, what occurs with the tax structure after the program expires? Now, you've gone to Greece, you've invested, and let's say this program lasted 15 years. What happens after that point in time? And a related question is, and maybe the ambassador can pipe in on this one, what are the chances that Greece could one day impose a special wealth tax once they have the new wealthy person in their tax clutches? Those are the questions. Maybe you can answer the first one, and maybe the ambassador can answer the second one.
Okay.
You chose the more easy for me, huh?
Okay, let me try to answer the first. When the program expires, if ever it will expire, because I'm thinking that it will be a program that will be enlarged a lot after the 15 years, but we are going to see. When it will expire, then internal tax rules are going to apply.
Thank you. And Ambassador?
So I think I would agree with Aspasia, although I don't know the details. Usually what happens horizontally is that the horizontal rules are applied to new residents as well, once there has been a legality, let's say, in the status of the economic profile of the interested person. Now, in coming back what I told you on the strategy of the Greek government, what this government has been, and they have been very vocal on it from day one, is that the government wants to create a secure environment for whoever belongs to economic activity and whoever is involved in Greece, resident or non-resident. This means that the usual question being that every time, I mean, every couple of years, we might have a new legislation specifying things which were advantageous in the past and creating new circumstances. This was a no-go for this present government. They said we will create some specific structures. They will provide security in the economic environment. This new law, tax law, is one of the major laws being included in this overall approach concerning the security of the environment. And many of these aspects have been discussed with the opposition parties. So we have a consensual sort of approach on much of it, either, I mean, at first sight or behind doors. So I don't believe we will have many moves opposing these regulations which are now in place.
But there is no, thank you, Ambassador, but there is no special constitutional override to change this legislation by a future parliament. All they would require is a simple majority if a future parliament was intent on changing.
Yeah.
Do I have it correct?
You're absolutely right on that, because 2/3 is required on very special circumstances and occasions, and you know that they are deeply political. This is growth. We're talking now about growth and about regulations having to do with stability in the market, attraction of investment, well-being of citizens, etc., etc. So I come back to the previous, I think I told the previous point, when you have some sort of consensual approach, which is very democratic, to specific, let's say, top priorities of the country, even if they are economic, and you know, economy is a forum when very nasty things are being exchanged on so numerous occasions, then I consider that it is secure. And this is one of the cases, I guess. It's not being discussed for the first time, it's just being articulated for the first time, and it is there for the first time. Thank you.
Great, okay, thank you. I think that answers the question fully. And I think at this point, I would like to draw an end to the questions because we're just 1 minute away from our scheduled closing time. And may I call on you, Madam Ambassador, to just provide any concluding remarks or observations?
Well, I was hoping to have your own concluding remarks. I thank very much Aspasia. I didn't have the pleasure to listen to her, her expertise so far. I see that is an ambitious scheme. It can be of interest. The specificities of the Canadian law, I think they should be revisited a bit. If we want to have a practical way of moving forward, then perhaps we need to make a little code. What's the best cause for any interested person to proceed to that? Auditing is always very complicated. I shouldn't say that we must simplify it. However, if there is an interested person in this new law, he has to have, I believe, a guidance, easy going sort of guidance. But I would be very eager to listen to your own remarks. Personally, I thank you very much. Lots of it I didn't know, the details and everything. It's good to know, and we will continue this dialogue, I'm sure, and we will come back to it. And thank you very much again.
Yeah, thank you, Ambassador. And perhaps if I can just, I assume the embassy and the consulates in Canada are able to provide some information as to the Greek side to people who are interested in further information.
On that, we will have to connect with the ministry in charge. As I said, it's very specialized. But I mean, over the last year, with the new programs we're having, the outreach of the citizens to governance, let's say, I think that every interested person could apply and have specific answers to their requests. But there also we will need the guidance of Aspasia, because she's in charge in this field, and she will give us, let's say, the horizontal approaches and the steps to be followed.
Great. Thank you, Ambassador. Thank you for your support and making the time to be with us today. I think if there was a couple of takeaways, one of them is that if you're going to consider changing your tax residency, you should not do it without some solid, experienced professional advice on both sides of the ocean. And the second observation I would make is tax should not be your primary consideration in determining if you're going to expatriate or not. It has to be lifestyle, family, other reasons, rather than tax, because saving tax in the place we hate to be is not much of a consolation. So with that, I'd like to thank Aspasia Malliou and James Belesiotis for the generous contribution in both time as well as the preparation of the materials that they shared with us today. Last but not least, I want to thank all of you who attended today. If you want to learn more about the work of the Hellenic Initiative Canada or consider supporting us, please visit our website or follow us on social media. Our next webinar on Greece's biodiversity will be on February 17th. And again, you can find some information on our website. Again, thank you very much. We're just 3 minutes past our allotted time. And we will make an effort to answer questions that were submitted that we weren't able to respond to on air. Again, thank you very much, and enjoy the balance of your week.
Thank you, everyone.
Bye-bye.